What are the 7 things you should know about using HomeReady and Home Possible financing? My name is Borja, and that is what I'm going to tell you about in this week's episode of the Mortgage Minute. The first thing you should know about HomeReady and Home Possible loans is that they only require 3% down payment on conforming loans. If you are doing a high balance loan, then the minimum down payment requirement is 5%. So what is a high balance loan? A high balance loan is any loan that exceeds these limits depending on the number of units that the property is made up of. Now notice that there are different limits for the contiguous US, DC, and Puerto Rico compared to Alaska, Guam, Hawaii, and the US Virgin Islands, where the limits are quite a bit higher. The second thing you should know about HomeReady and Home Possible loans is that you do not need to be a first-time home buyer. So if you have owned a home in the past, that's okay. As a matter of fact, in certain situations, you can currently own a home and still be eligible for this special financing. The number 3 thing that you should know about HomeReady and Home Possible loans is that lower mortgage insurance premiums are possible with that type of financing. The cost of mortgage insurance premiums does vary depending on your exact down payment percentage as well as your credit score. But let's take a look at one example. Let's say that we have 2 people, both of them purchasing a home of $500,000 and putting 5% down. Both of them with a 680 credit score. If they are using a HomeReady program, their mortgage insurance payment would be $312.71, as opposed to Mr. B, who would be paying $349 on mortgage insurance given the same parameters. The number 4 thing you should know about these types of loans is that they have a lot of flexibility as to the source of the down payment. It could be from your own savings, retirement account, gifts from relatives, and even down payment assistance programs can be combined to come up with both the down payment and the closing costs needed for the transaction. What are closing costs? Check out the video and find out more. The number 5 thing you should know about HomeReady and Home Possible loans is that mortgage insurance can come off once the loan balance reaches 80% of the original sales price or appraised value if you used it for a refinance. Because that's right, HomeReady and Home Possible can be used for both purchase and refinance. So that's a bonus fact. The number 6 thing you should know is that HomeReady and Home Possible loans do have income limits based on the area median income. Let's take a look at the income limits for some of these Southern California counties. Please note that the limits are not affected by the number of people residing in the household. And the number 7 thing that you should know about HomeReady and Home Possible loans is that they do require that everyone, whether you are a first-time home buyer or not, take a home ownership counseling class. It can be done online, and it's the equivalent of about 8 hours worth of work, but it is well worth it in order to utilize this type of financing that has a lot more flexibility when it comes to qualification, and in many cases, much better interest rates. So there you have it, a quick look at the HomeReady and Home Possible loans. If you have any questions about this or any other mortgage or real estate related topic, please reach out to me. You can send me an email, give me a call, shoot me a text, or of course, connect with me on social media. Please give this video the thumbs up if you enjoyed it, share with everybody on your social media network, and if you haven't already done so, subscribe to my channel and ring the bell so you're notified of all the videos as they are posted. Thanks for watching, and I'll see you next time.